Hey, welcome back. So this is now we're gonna go over. Well, the main thing I want to go over is what do we do if it just does nothing, briefly, and what's the actual cost of it. So let me adjust this back to our original U shape. And so this might not look quite that steep, but remember we zoomed out. So it's all relative. Each one of these lines is tens of thousands of dollars. So let's get back into Normalsville. We're not quite rolling that deep yet. We don't have that FU money, we just have that passive aggressive money. So we're over here. This is what happens day to day to the value of what you're holding. Day 1, day 2, day 3, day 4, day 5, day 6, day 7, day 8, day 9. Each one of those clicks is a day. As you can see, and this is why I bought out so far out into the future, day by day, it's not that big of a deal. So if this is highly volatile, and it's very unlikely that it's going to stay in place, how likely is it going to stay in place for that long that I just clicked? Each one of those clicks was a day. If it really went against us in that sense, we got so unlucky. But look at that damage. It's not even, compared to the gains we were trying to make, the amount we lost is not a lot. So what do we do here? We have a number of options. But depends how savage you are. Because if you think about it, we gave it this many days for it to sort of find itself, and it decided it's not going to do anything. It's just stubborn. And by the way, this is where I meant for the price of stock to be. Like I said, it was in the middle. We're making that U shape from it symmetrical. So where do we find ourselves now? Because like I said, when we entered in a place of neutrality, price neutrality. We don't know if it's a good price or a bad price. What has happened by it simply simmering down now and just being where it's at and not doing anything? By definition, volatility has gone down. So what does that mean? Yes, let's go back to the whiteboard. Here we are. Oh, I guess there's a different shortcut for that. Let's try this again. Here we are. No, I don't want to remove the whiteboard. Here. Okay. So, volatility went down, and so here's where we find ourselves now. As you saw, we're slightly in the red. We went down this much. Okay? And again, we were positive calls, negative calls, positive calls, positive puts, negative puts here. So what happened to these prices? Everything went down. Remember that ripple out into the future? So each one of these has gone down. So we've lost money on these, but because we were short these, and now these are worth less. So if we don't mind accruing a tax gain here, or little capital gains here, if we close this and this out, and this is not what I suggest, but if we did, that means that we have uncapped gains going on both sides. Now, where this is going to hurt you is it's going to increase your theta exposure way more, because you're no longer going to have the short position working for you. But you'd be waiting to take advantage of when volatility does spike up. I don't recommend this, by the way. Better way to do it would just be to simply buy more. It's actually probably long-term more beneficial, but if you're just a savage, and especially if you're like, this is the kind of stuff that I would do if I'm more so leaning towards one way or the other, because at least I would still have one of those shorts still giving me some theta. But I'm like, but it's gonna go up, so I'm gonna close these out. The common wisdom about closing short positions in options is if it's worth less than 50% of what you sold it for, just get rid of it. And the logic behind that is that you've squeezed half of its juices out already. So the most it can give you is what it's already given you. So there's you can get more out of something else. That's the thought process behind that. So simply, the answer here is either double down or roll it. Roll it meaning if enough time passed where these were Jan 23, we're recording this in January, in April of 2021, so we initially bought this far out into the future, and then enough time has passed where now we have, say, the June 23, because it's midway through the year. You can close these out, harvest a tax loss, close these out, harvest a tax loss, open them up in a later date, and then just rinse and repeat what I suggested. Because that was our thesis. If we no longer think that it's actually going to move, then don't do that. But come on, it's Coinbase. Is it just gonna? Is it basically just gonna like mirror the U.S. dollar? Is that a likely scenario? Yeah. So this is actually super unlikely. So if you think about it, the scenario where we're describing, we're still gaining something from this, which is if you're into tax loss harvesting, this is one strategy for doing that. We still gain a positive from it, and it's the least likely scenario. So that's why I set up our criteria for the strategy ahead of time, which is we want something that's highly volatile. We don't know if we're getting a good price on it. We don't know if it's going to go up or down. And I'm doing this symmetrically because this is me right now. I don't know. It's a big shrug. The graph is just shrugging. Like the hands are up in the air. It could go up or down. I don't know. I don't care. It's just a big IDK graph. It's a sad, confused, he's given up on life. That's what this map is. But you can still make money from him. Okay? It kind of looks kind of brutal. I'm gonna get rid of that. So, just as a little reminder, this is not financial advice. This is all if you're doing anything more than simulated trades of this to just learn, playing with real money, especially with options, you can get burned. So everything you do, be careful. And lastly, just to follow up with the fact that we created our ideal graph. I mean, obviously that's not the end of the road. Let's just finish this off real quick. So we had this. We turned it into, say, this. Now what? I mean, it should be pretty self-explanatory, but I'll go over it anyway. So we're here. we want it to do that, when it goes up there, sell it. That's it. Same thing here. So hopefully that all makes sense. Leave your questions down below. This passive aggressive money. Pretty much think that covers it. And like I said, you can apply this to everything that fits this criteria. And I guess since my last video is way longer, let me switch back over to our mind map here. We want to be here. And okay, this is going to be a little impromptu. So let me move myself. No, there I am. Let me move myself a little bit out of this way. And we're just going to do a quick review here. Can I blow this up? I can always zoom in, right? One sec. Oh, I've selected the white background in the back. One sec. So window capture. Here we are. Whatever. I'm just gonna zoom in here. Where is it? Here we are. Boom, 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 boom. Okay. Can we get rid of this stupid color scheme? There you are. So now when I select, this should be able to move this around. There we go. Okay, doesn't really matter anymore. So here we are, like on your little conscience, your little floating star there. So we're gonna look over here now. So our desired criteria, we want something highly volatile, speculative. I don't know if it's gonna go up or down. It's unlikely to stay in place for long. And I don't know if I'm getting a good sell or buy price. So that's why we're doing everything we did. Next up, the context is that there's a cost and benefit to every trade. You can read along. If not, I'm not sure how big your screen is going to be. This strategy's cost, look over here, is the time decay over time. So that's the price we pay for this strategy. This was mitigated by being really far out into the future, and that's where time decay affects us less. Of course, the cost of this is that if we want to have an uneven distribution of having more bought calls or bought puts than we have sold, it's going to require more capital. So things out into the future are priced longer because you're buying time. That's the price you pay there. If you eventually get really good at options trading where you've accrued a big nest egg and you can actually take advantage of that, you can give yourself an even longer lifeline to make disproportionate gains. So that's how winners win more. Let's move down here and zoom in a bit because you might have to scroll to the side. So the actual strategy. So let's see. So here we are again. Over here, we have entry neutrality. So we gave ourselves time buying far out into the future, assuming we don't know the volatility history, because in this case it was the Coinbase IPO. We don't know if the prices are inflated or not. So we're buying and selling at the same time. Right? And yeah, that's what this one says. Let me move myself out of the way here. So over here, something's going to eventually happen. So this is step 2. After we've entered very neutrally, something happens. Okay? Goes up or down or goes sideways. Can't do anything else. It can go up more than you expect, or it can go down more than you expect, or less, or it could take longer to do it. But that's why we buy ourselves time. And that's why we're not day trading here. This is being patient, right? This is investing and trading. So then we take advantage of the fact that it moved in a way that benefited us. So we make our adjustments for outsized advantages to us. Previously, we did not know when we entered that it was a good price. Now we have a better idea. So now we know which side we've inflated, which side has deflated, and we can adjust our position that was initially neutral to then, just way more outlandishly gains in the opposite direction, because that's why you also want to buy yourself time, because it's not going to go up and down within the same week. It can, but that's not ideal. In fact, that's kind of scary. But it's also, if you're used to that, it's kind of fun. Let's see. I need to decompress my back. So we made our adjustment. So we sell in the event of a move and take advantage of the volatility spike, right? So let's say it moved down. That means that those puts that are way out into the future are going to have a huge volatility spike. So if we sell out of that, we're going to get a great price, and we're going to get our capital back and get a great price on that, because we know we're selling right at the moment of a volatility spike. We put our foot in door neutrally, but then we got out at an ideal time. We also can do the opposite if we're savage enough. Yeah, so the more tax efficient way, like if you, instead of just like actualizing all your gains, we've specifically bought out over a year into the future. So let that expire and give yourself long-term taxes. In the meantime, just open a position to sell against it. You can even harvest a tax loss, and don't accrue a tax gain. It's pretty simple. It's a different position that you're opening up. So you're not trading out of that position. You're just gaining liquidity against it. All right. Last point over there. Yeah, I'm just making a point that I like to potentially lose 100% of a smaller amount of money. Oh, and I pretty much just said the same thing over again, just in more specific step-by-step turns here. So we'll go over this pretty quickly. So we're buying out of the money calls, verticals, out of the money put verticals, and that's how we create our neutrality on entry. If it's up, we remove the capital from the calls. If it's down, we remove capitals from the puts. If it wiggles, as in stays in place and just kind of like doesn't do anything, roll it in, maybe harvest a tax loss. And if you're a madman, close both the sides, actualize your gains, and just like make it super steep, but I don't recommend that. But if it goes in your favor, you can make some crazy gains doing that. So we've adjusted into the favor and the ideal way we want it. So remember, we had our big giving up on life graph, and then it decided to do like the wave up to this over here. So we get our gains over here, and then we just kind of we pose and we make the gain way more on the opposite side. And if we are fortunate enough to actualize the gain when it goes in the opposite direction, because this entire sort of thing was like us preheating the oven to create a position that is disproportionately in our favor, the natural thing to do next is, if it eventually works in our favor, to then sell when it goes up, or just hold it and have it keep going up. But I don't get greedy. I like to live to trade another day. So that's pretty much it. Let me make myself a little bigger. Thanks for watching. This is Passive Aggressive Money. Do everything at your own risk level. I don't know your risk tolerance. So the amount that you kind of like adjust the steepness of your gains and losses and the amount of theta, it's all up to you depending on what you can stomach and what you're trading with. So again, leave questions below. This is Passive Aggressive Money, and I bid you adieu. Take care.